Hey everybody, welcome to this episode of Wealth Simplified. I am your host, Tony Raymond, owner and wealth advisor at Raymond Financial. And on today's episode, I really wanted to talk about when you're saving for yourself, what are the different accounts that you can invest in? I know we've done some videos before talking about what are stocks, bonds, mutual funds, and other types of investments. Well, now I wanted to tackle where do we put those investments. So for today's video, I wanted to talk about taxes and how they affect it and talk about three different areas or types of accounts that you can invest in that are each taxed a little bit differently. So one, we'll talk about just the standard account, sometimes called a brokerage account, sometimes called an individual account. People have a lot of names for it, but it's just a standard account. Then we'll talk about a pre-tax account, which we'll use the traditional IRA for this example. And then we'll also talk about an after-tax option, which we'll use the Roth IRA for this video, for this example. So really just to kick it off with the standard account and how that works, you can open the account and it's essentially empty. It doesn't earn a set amount of interest. It doesn't earn anything until you choose the investments to put into it. So for the sake of these examples, let's say we pick a mutual fund and it earns the same interest rate as it's going to earn in all the other accounts. So in a standard account, let's say you put $10,000 into this investment. And 5 years from now, it doubles and grows to $20,000, and you decide, I want that $20,000. Well, when you go to take that, you have to pay tax on the difference that it earned. So the $10,000 that you put in goes back to you, no taxes. The $10,000 in interest that it earned over those 5 years is then taxed at a capital gains rate, which is different than ordinary income, but we won't get into it. All we want to focus on is that difference of the $10,000, which is taxed. Also to mention that each of the 5 years, if that investment is paying you interest and dividends, you'll pay taxes on those the year in which you get paid. So there's a little bit more to it, but for the basic idea of this video, standard account, you put $10,000 in, it grows to $20,000, you sell it, you only owe tax on the $10,000 that it earned, and you get the $10,000 back free. There is no eligibility requirements. As long as you're 18 years of age and a U.S. citizen, you can open a standard account. You have a social security number. You can put any amount that you want into it. There isn't a cap on it. So you can just choose what you want and have that full flexibility for that option. There isn't an age requirement of when you need to take it out. You could have that same account for forever, essentially. So second piece I wanted to talk about is pre-tax accounts. So a lot of people are familiar with these as you have a 401k, most likely. For this episode, we're going to use a traditional IRA, which just means that only one person can own it. So if you work at a company where you have a 401k, everybody has that same 401k. An IRA is only tied to one social security number. So it's one individual, hence the name individual retirement account. So in a traditional IRA, which is a pre-tax option, you can put $6,000 a year into that account. That's the maximum. Unless you're over the age of 50, then you can do $7,000. That's as of 2021, those numbers. So you put your $6,000 in. If you're not covered by a work plan, you can get a tax deduction on that $6,000 that you put into the IRA. But for the purpose of this video, what we're going to focus on is what happens after it gets into the account. So let's say you put in that $6,000. In over 5 years, it doubles and grows to $12,000. If you wanted to take that money before the age of 59 and a half, you would pay tax on all of it and a 10% penalty. So if you put $6,000 in, it grows to $12,000, and let's say now you're 45 years old, you go to take that $12,000 out, you pay tax on all $12,000, and you get hit with a 10% penalty. So different from that standard account that we talked about. Eligibility, you have to be working, you have to have earned income up to the amount that you're putting into that account. You have to leave it in there until 59 and a half, age 59 and a half, to not get penalized that 10%. Whenever you take it out, it is fully taxable. If that account grows all the way to $1 million and you take money out of that account, each dollar of it is taxed at your income rate at the time. So some people choose to use it thinking that they make more income now than they will in the future. So they'd rather get a little tax break now and in the future pay the taxes on it when they're assuming their taxes are going to be lower. That's who would utilize it. For the tax-free option that I wanted to talk about, which can be very, very powerful, especially for younger people, we're going to use the Roth IRA option. Again, IRA, individual retirement account, one social security number. In a Roth, it's the same limits, the same $6,000 a year, or $7,000 a year that you can put into it if you're over 50. There is some income limit. So if you make a certain amount of money, which will change each year, you can't put any more money into a Roth IRA. That amount varies for single people versus married people. So you can either look that up or talk to an accountant about it if you're thinking about putting money into a Roth IRA. So once money's in the Roth, let's say you take your same $6,000 over 5 years, it grows to $12,000. In this case, that $6,000 that you put in the beginning is accessible to you at any point if you should need it. So sometimes I call this the Life Happens retirement account. That money that you put in, you can access. So it's kind of like a savings account. If you have the fortune of not having to touch it and letting that sit forever, and it grows to that $12,000, then all of that money will come out tax-free. It won't count as income. You don't owe any taxes on it. The reason is when you're putting money into the account, you've already paid taxes on that. If you're getting a paycheck, it comes from your employer, you pay taxes, it goes into your bank. Well, then you take that money and put it into the Roths, you've already paid taxes. Then you never pay taxes again. You do have to wait until you're past age 59 and a half to be able to access the interest inside of the Roth IRA. So if you did the 6,000, it grows to 12. Like I said, you could access that 6 that you put in, but that 6,000 that was only earned interest, you have to wait until age 59 and a half to be able to access that money without paying taxes on it. So those are really I call them the big 3 for taxes. So taxable, you only pay tax on the difference of what you invested and what it's worth now. Traditional IRA, where you might get a tax break now, but you owe taxes on every dollar in the future. And a Roth IRA, where you've already paid taxes on that money, and once it goes into the account, you never owe taxes on it again. I love to use that example of if you have $1 million in a traditional IRA, every dollar is taxed. So if you're paying 30% tax, you actually have $700,000. In a Roth IRA, if that grows to $1 million, you take it out and all $1 million of it is tax-free. So it doesn't hurt you. I think Roths are a huge benefit for young people that can understand them, especially with that flexibility that you have of being able to get that money out. So that was really just the basics. That's all I wanted to cover for this video. I hope you got something out of it. As always, feel free to let me know. I'll throw my email up on the screen, what you would like to hear about, what you would like to talk about, and also feel free to subscribe to the channel so you don't miss future videos. And I'll continue to try making these videos, getting them out there, and I want to focus on what you want to hear. This has been the number one question from people is, now that I'm understanding investments, what account do I put them in? So I was glad to make this video. We'll get that out there quickly. So I look forward to hearing back from you guys on what you want to hear, and I will see you next episode. Thanks, guys.